Sit down with your CPA after October 15th when he or she's done with all the tax returns. Try to get them to do a projection for 2025 and 2026, and then see what opportunities are out there.
The One Big Beautiful Bill Act has rewritten the tax landscape in ways that extend well beyond the Internal Revenue Code. And these ripple effects are already being felt across investment decisions, retirement planning, and long-term wealth strategies. In our podcast today, my guest, Bob Keebler, a partner with Keebler and Associates, will break down what you need to know about the One Big Beautiful Bill. Welcome, Bob.
Good to be here, Bob.
It's a pleasure to have you talk with us about the One Big Beautiful Bill. We have lots to get to. Let's start with the SALT cap. In 2026, it will go up from $10,000 to $40,000. And I'm curious, what advice do you have for taxpayers who are in these high tax states in terms of how they navigate this temporary nature and leverage maybe existing workarounds like the state pass-through entity taxes?
Sure. Like you said, it's a 10 today, or was it 10 last year? It's going to go to 40, including 2025. The most important thing is to time out your SALT payments, property taxes, and state income tax payments so that they match up with that $40,000 limitation best you can. You don't want to have like $60,000 this year and 20 next year. That'd be silly. It'd be better to push that last everything over the 40 into next year if that's possible under local law. Very often you have a lot of flexibility with your December, January payment to the state and flexibility with regard to when you pay your property taxes. Many states say either December or January, or December and January followed by a payment in June. So those are all things that are out there.
Right. So you would accelerate your tax payment into this year and do it for the following years until the cap goes away, back down to whatever it was, 10,000.
I would just try to make sure that you get to 40 every year.
Yeah.
That's the key. Now, the secondary thing we have to pay attention to is once you go over 500,000 of income, you could lose the increase in the SALT. So it's at 40. If you get to 600,000 of income, it goes back to 10. So that journey from 500,000 of AGI to 600,000 causes your income to actually go up by $130,000 because you lose that $30,000 deduction. So if you're in that situation, you want to do everything possible to get your income back below 500,000.
Also, in the One Big Beautiful Bill, Roth conversion economics change. And with these new tax law changes, there are some key opportunities, but also some pitfalls that retirees should understand.
The two big pitfalls are a number of pitfalls, but what are you going to do with your phase outs? There are like 8 or 9 different phase outs, so you have to test your Roth conversion against each of those phase outs. So if I increase my income by $20,000 by virtue of Roth conversion, how does that affect other aspects of my tax return? So that's something we need to be very mindful of. What advice do I have? It's to lay out and to totally test on a small incremental basis. If I convert 20,000, what's going to happen to my SALT deduction? What's going to happen to my senior deduction? Will that 20,000 impact my IRMA payment? Something you've been writing a lot about, Bob, in the last 3-4 weeks, how that's all changing. And what we don't want to do with IRMA is like stick our big toe over the line, meaning we go $100 over with a Roth conversion and suddenly our premium goes up by $150, $200 a month times 2 if both spouses are in Medicare. So very important to test all that.
Yeah. And when you say test it, I take it you should do this with the help of a qualified CPA who's using software to do a what-if scenario analysis?
Right. Work with your CPA and have he or she lay all this out for you so you understand exactly where you're going to be.
Yeah. Bob, you mentioned the senior tax deduction. We know that it doesn't necessarily eliminate your taxes on Social Security benefits, But this deduction is significant. It's a temporary deduction of $6,000 for taxpayers age 65 and older. It has a phase out, which I'm sure you'll talk about. But how does this change the tax landscape for seniors, and what are the planning strategies that they might consider in light of it?
Yeah, what you have to be careful of, again, there's a phase out. So if you decide to sell securities, take money out of an IRA, do a Roth conversion, you want to test it against all these phase outs, including the senior phase out, because that's a $12,000 deduction for a married couple. So we want to make sure we're staying below that, the start of that threshold, which is $150,000.
Yeah. And it's based on modified adjusted gross income as opposed to AGI alone. The
Correct.
difference is small, but it's meaningful.
And that's why work with your CPA to make sure you understand under the tax law what all these different definitions mean.
Yeah. Now, Bob, my understanding is with the senior deduction, it's over and above whether you're taking the standard deduction or itemizing deductions. It's in addition to those deductions. Is that correct?
Absolutely correct.
So then, in terms of folks who are trying to balance how to increase the total amount of deductions, when you think about whether they should itemize versus take the standard in addition to the senior, what's the sort of the rubric that someone might use to determine what's best for them?
Well, a lot of people should still itemize every 2 or 3 years. They may never get over that standard deduction. And that's what you have to sit down and look at. Take do I itemize in year 1 and then not itemize in years 2 and 3 and come back and itemize again in year 4? And the driver there would be, what are you doing with your charitable? Because that's what you can control the most. So maybe in year 1, I donate to my donor advised fund. And then in year 4 and 7, I rinse and repeat my donor advised fund. And then in years 2 and 3, I use my donor advised fund to make my charitable gifts.
Yeah. And just for folks who may not be familiar with a donor advised fund, maybe explain how that works.
Sure, I can transfer property from my name into a donor advised fund, and then I can determine in the future what goes to charity. So this year, somebody could move $10,000 into their donor advised fund, pay the take the tax deduction, but not give that money to charity to the future.
So in that case, one, as you mentioned before, you're either accelerating deductions into this year and deferring income, or perhaps you won't be accelerating income or maybe you'll be accelerating income and deferring deductions to another year. Is that the two main tactics that people think about, right, when they're trying to take advantage of itemizing deductions?
Well, exactly. You have to time that out, and then you'd have to determine. So you can't control the three deductions most people are going to have will be SALT, charity, and mortgage interest. Nothing we can do to control our mortgage interest. That's just a monthly payment. The SALT we have a little bit of control over, but charity we have a lot of control over. So maybe if I'm older and I've already paid off my mortgage, maybe again in year 1 I itemize, and in years 2 and 3 I would just take the standard deduction. Because remember how large that standard deduction is now. So
And
very
it's
few
tied to
people,
inflation, right?
it's tied to inflation. Very few people can get to that itemized deduction number every year.
Yeah. You mentioned SALT as one opportunity. There's one topic under SALT that I didn't mention, which is this notion that in some cases, taxpayers have been able to use state pass-through entities to take advantage of SALT. Is that something that's still available to folks?
Absolutely still available. So we do that with many of our clients, S corporations and partnerships. We have the entity pay the tax, and that way that deduction never makes it to the individual's 1040. It's just taken on the entity level. So if the entity made $1 million and paid $90,000 of New York tax, it would only report for federal purposes $910,000 of income. So that would be the beauty of that, because then Then you avoid this whole, do I itemize? Do I not itemize? Do I have a limitation of 40,000? You get around that entire limitation.
Yeah. Let me go back to charitable giving for a second. For folks who aren't itemizing, there's an opportunity to deduct charitable contributions, though there is a limit on how much you can deduct.
There are some limitations now. The basic limitation beginning in 2026, so circle that in your mind. For 2025, this rule doesn't come into play. If somebody made $500,000, they could only deduct everything over $2,500. There's a 0.5% haircut, and that's what we have to understand.
So, how might that change some strategies who are for retirees who are trying to be philanthropic?
Well, I think for many of my clients, this will be the year they itemize because we don't have to deal with that haircut.
Yeah.
And then next year and the year after, we wouldn't itemize.
Yeah.
It just depends how philanthropic they are. Some people are so generous that they're just going to itemize every year. But then we're going to accelerate using a donor advised fund or using a private foundation. We'll accelerate into 2025.
Bob, we have to take a short break. And when we come back, I want to talk about small business owners and the retirement planning opportunities. I want to talk about Trump accounts. I want to talk about estate planning opportunities as well. So don't go away. Welcome back to Decoding Retirement. I'm speaking with my good friend, Bob Keebler, partner with Keebler and Associates. And even though you're a Packers fan and I'm a Patriots fan, we're very happy to have you on the podcast today.
Well, glad to be here.
Yeah, it's a pleasure. So let's talk about what small business owners can do with respect to their retirement planning. My understanding is that there's a QBI deduction that's now permanent at 20%, and that there are some implications for small business owners and how they can take advantage of the qualified business income deduction.
Sure. The QBI deduction came into law with the Tax Cuts and Jobs Act. So very important to focus on that. And it's a 20% deduction. So if your plumber made $100,000 and he was in partnership with 2 or 3 other plumbers, they would each, if they each made 100, they would only pay tax on 80. That's the important thing for us to know. So we have to start there. You'll pay tax on 80, and you have to qualify for that by having the right amount of wages for your employees or the right amount of capital invested. But it's something everybody should explore. The government made this deduction a little bit easier to obtain because they expanded the phase out. So the phase out used to be over 100,000. Now it's over 150. So even there's a group of people called specified service trades or businesses, doctors, lawyers, CPAs, that aren't allowed to take this deduction unless their income is low enough. And for that group, you really need to sit down with your CPAs and see, where does your income fall against these phase outs?
Yeah. There's also some opportunities around investment planning, something having to do with the qualified small business stock exclusions. What do retirees need to know about that opportunity?
It's a big issue with small C corporations, not S corps, but small C corps. Under the new law, you're going to be able to exclude $15 million a gain. So if 2 young people, Bob, graduate from MIT, they venture off into the world, they create a new venture, and they are going to be able to, if they sell it 5 years after they create it, they could each exclude 15 million of the gain. Now, today the law says 10 million. It's for existing ventures. They're going to expand that to 15. And if you'll hold it only 3 or 4 years, you'll still get a partial exclusion. So this is a very big thing. Won't affect most of my retired clients because they're not in a closely held business. But you'd have to be in a closely held C corp to make this work.
Um, a lot of folks have been asking me anyway, Bob, about the Trump accounts and how they can take advantage of these accounts and how they measure up against, say, 529s or IRAs. Do you have some thoughts about that?
Well, I think I've talked to a number of 529 experts on this. The go-to will continue to be the 529 plan. But if a family has enough wealth that they can fund both a Trump account and a 529 plan, the plan with the Trump account would be when the child turns 18, or maybe 22 once they're past the kiddie tax, the child would convert that Trump account into a Roth IRA. Maybe the year you graduate from college, Bob, when you only work half a year, you graduate in May, start in July. That would be the year you'd flip your Trump account into into a Roth IRA. So the government will put $1,000 in the account. So if a baby was born October of 2025, we could put $1,000 in that account from the government, coupled with $5,000 each year from the parents up until the child's 18th birthday. Can't do it once they're 18, but you should be able to put 18 times 5 or 90,000 plus the 1,000 from the government. But then if it's invested in a broad index fund, call it the S&P 500, it should grow substantially to where it's several $100,000 by the time the child's 18.
Yeah.
And then they can flip it into a Roth, and then it can grow tax-free until they, need it when they're well into their retirement.
Yeah. I think the key is obviously the 529 is better, so fund that first, and then if there's anything left over, use the Trump account.
Correct.
Yeah. Let's talk a little bit about the permanency of these tax rate changes that are part of One Big Beautiful Bill. It strikes me before this happened, there was so much conversation and hand-wringing over the possibility of these lower tax rates going away, and you should do Roth conversions now versus delaying, et cetera, et cetera. Now that these are permanent, it takes away, I guess, some of the hand-wringing, right? There's some long-term opportunities that people can take advantage of now that these tax rates are permanent.
Well, right. We know what the rates are. And what we have to be cognizant of is the political pendulum in America always swings, right? And certainly in the future, we could have higher rates. So a lot of people are basing their strategies on very aggressive tax planning through the end of 2028 while we have these lower rates. Roth conversions, taking money out of IRAs, buying insurance, things like that.
So speaking of that, maybe talk a little bit about some of the ways that retirees could save taxes under these new tax rules, including the new tax rates. Are there some common planning pitfalls they should avoid or opportunities they should take advantage of?
I think the number one thing is to make sure you're timing your itemized deductions and SALT correctly. Number two thing is working with your advisors on Roth conversions. Talk to your CPA about that, figure out where your threshold is. Right now, we have this very large estate tax threshold, and we really need to be, for some people, they need to be prepared if the law changes in the future that they can make gifts. I'm not saying they should make gifts today, but they should be prepared to make gifts tomorrow. And that means having a good, solid relationship with an estate planning attorney, maybe even setting up the shell of a trust that you and your lawyer have designed so that later you can fund it. It's not urgent, but it's important. And then looking at basically the biggest thing is timing out capital gain, itemized deductions, Roth conversions. I mean, we could go through 20 things, but those would be the heart of it that most people can add tremendous value.
So we've covered a lot of ground in a very short period of time. Anything we missed or just bears reemphasizing?
I think what I would reemphasize is that sit down with your CPA after October 15th when he or she's done with all the tax returns. Try to get them to do a projection for 2025 and 2026, and then see what opportunities are out there. Use some of what we talked about today as kind of a checklist of what you should be looking at, and just be really organized for that meeting with your CPA because you want to use his or her time to do a lot of thinking, not just to help you get organized.
Yeah. And I think you in the past have told me that the best time to do it is like now. Don't wait until year end when things are sort of hitting the fan for the CPA in terms of whatever, right? Year end statements and blah, 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 right?
Right. If you can get their attention sooner than later, that's going to work out better. CPAs across America are very busy, and if clients can come to them early, it really helps.
Yeah. Well, Bob, I really appreciate you giving us sort of if only a surface level advice in terms of what people need to know about the One Big Beautiful Bill. It's so greatly appreciated, and hopefully you'll come back on. We could do a deeper dive into other topics that we didn't cover today.
I'd love to come back.
Great. So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you better plan for your taxes and your retirement. Remember, you can listen and subscribe to Decoding Retirement wherever you find your favorite podcasts.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
I'm Elizabeth Gore. Welcome to The Big Idea.
Welcome to Yahoo Finance Sports Report.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.